Here is the fifth video of the demand curve strategies series that I'm doing. This one is a continuation of the previous talk. I introduced the ready reckoner that showed you how I calculate the demand curves from the trade-off analysis. And I called it ready reckoner because that is really the ready reckoner that you can use for promotions, etc. Now there's a difference between demand curves at parity prices and at market prices. So far I've only worked with parity prices. I will explain the difference later. At this stage I'm going to show you what happens if we use the calculator at market prices. To make an important point, markets settle over time. In other words, when I look at demand elasticity at market prices, you are looking at a slightly less elastic demand curve because the competitors have settled themselves in with specific positions which they execute in their pricing, and that then gives them a little maneuverability, but not as much as if they're just starting off and all at parity. You're really looking at promotional, tactical thinking with this, what I'm presenting here. Also going to show you that SA Breweries very cleverly bracketed Heineken by an interplay of two things, the pricing and the positioning of the brands. That is important. It's both that does the bracketing. Okay, this is just an extension of the ready reckoner. We are working with respondents or respondent share, and we're working with market prices. So you can see that Castle Lager is in at price level 2. These come from the macro prices. Windhoek Lager also at 2. Lion Lager also at 2. 2 is 55 Rand. 1 is 50 Rand. And so forth. We are analyzing what is happening to Heineken. If Heineken increases, starts off with price level 1, it'll have a 52% of the respondents. And then as it increases its price, it loses respondents. Bearing in mind that we are now working with the prices as it is at macro. So Heineken we know is at price level 4, at which stage it should have about a 17% of the respondents. If it now increases its price to price level 5, you'll see that 2% will go to Windhoek Lager. You'll see 2% will go to Amstel Lager. 1 will go to Hansa, 1 will go to Windhoek Light, and 2 will go to Castle Light. Not the fantastic elasticities that we showed when we were dealing with all brands at parity prices. You can see that the market has settled over time. The marketers will learn at what level they can sell, and they know that if they make a change to that level, the competition will respond and set a new balance. If it decreases its price, which is what marketers are probably more interested in mostly, you'll see that Castle Lager will lose 2 to Heineken, Windhoek Lager 2, Lion Lager 2, and Windhoek Light 3. In fact, that fantastic price sensitivity with Castle Light has disappeared, function of the market settling. Let's look at what happens to Castle Light at market prices. Well, this is really fascinating. Breweries have got Castle Light selling at price level 5, which is above that of Heineken. Price level 5, it should only have 7% of the respondents. You'll see that if it increases its price, it only loses 1 of those percentages. And if it decreases its price, well, it gains 4, which is quite a lot, given that it only has 7. But look at the competitiveness. Windhoek Lager is the brand that will gain if it increases price. If it decreases price, that will be Amstel Lager that will lose. Heineken will lose. Okay, let's now play with Windhoek Light. Simulate the situation for Windhoek Light amongst this sample, small sample. Well, Windhoek Light sells at price level 1. It is a cheapy brand out there. And if it increases its price by 5 Rand to price level 2, you'll see that it loses half of those respondents. Where do they go? Well, they go to Windhoek Lager, 4 of them. 3 of them will go to carding black labels, surprise, surprise, and then there's a spread of other brands that they will go to. And let us now play with Castle Lager. Again, in this small sample, but the extent of the moves is not determined by the market being small. A bigger sample will probably have similar small movements. But if Castle Lager increases its price to level 2, you'll see that it will lose to Lion Lager and Hansa Pilsner. Well, a little bit, not that much. If it decreases its price, it will gain a lot. It will gain nearly 8% of these respondents, and you'll see it is a Carling Black Label that will lose the most. Windhoek Light will lose 2. Heineken will only lose 1. Okay, so we can now take the previous slides that I showed you and compile a threats grains market picture for Heineken. We're dealing with short-term promo prices. Really, we are showing the brands here: Windhoek Lager 55 Rand, Castle Lager 55 Rand, Lion Lager 55 Rand. Heineken is at 65 Rand, and then the real premium is Castle Light at 70. If Heineken decreases its price, it will get 3 of the Windhoek Light users. If Windhoek Light decreases its price, it will get 2 of the Heineken users. So you can see how those two interact. On the other hand, if Heineken, when it decreases its price, it will get 2 from Windhoek Lager, 2 from Castle Lager, 2 from Lion Lager. And in fact, when Castle Lager decreases its price down to 50 Rand, it will get 1 of the Heineken users. I'll be switching between the Castle Lager and the Heineken, so I can sympathize with those people. You can see Castle Light, if it decreases its price, it will hurt Heineken by 2, but Heineken doesn't hurt Castle Light. Brilliant positioning. Okay, now so far I've been talking about respondents and what happens with respondents. Remember, we did ask people how much they buy, and let's just look at what happens with the volume shares. It is important to note that normally with market research, you only look at respondents. Then you get your AC Nielsen reports, and you then deal with volume shares. You and the whole company react to the volume shares a lot stronger than what they react to the respondent shares. You might tell the company, well, I've been gaining respondents or users. Then that might be true, but it doesn't cut a lot of ice with them when they see your volume shares go down in the AC Nielsen presentations. So let us look at what happens with Heineken. Heineken increases its price, and Castle Light will gain 2% of the volume. Decreases its price, well, it'll hurt Windhoek Lager 3, Hansa Pilsner 4. A little bit of Castle Light, but in reality, its volume changes are bigger than the value changes, indicating slightly heavier users are switching, and there's going to be a real problem if it tries to increase its price to compete with Castle Lager. Okay, let me just summarize. Previous talk, or video, I showed you the Red Reckoner, or the calculator that I used. This talk, I showed you what happens when we apply it at different price levels. There's a big difference between the demand curves at parity prices and at market prices, and both of them has important implications for the brand manager. Markets settle over time, very important. What happens is one brand will increase or decrease its price. If it decreases its price and hurts another brand, that other brand will also decrease its price. So there will be retaliation. Therefore, promo prices are very often only short-term strategies to, well, reward the retailer, give the sales force something to do, and to bring your volumes up in the Nielsen reports. But you'll settle over time. Demand curves at market prices is more important for promos, promo pricing, tactical thinking Obviously, you have to get your tactical thinking and your strategic thinking in line with each other. And I showed how SA Brewery very cleverly bracketed Heineken with the interplay of pricing and position, with especially Castle Light being priced above Heineken, i.e. getting better returns, and that is due to a positioning just above Heineken. Well, that's it for the 5th video. In the next one, I will be playing with the volumes and the values of these demand curves, because they become important when you're dealing with your Nielsen shares and also when you're dealing with your financial department in terms of setting these prices.